Hi everyone, welcome back to my channel. My name is Courtney and today I want to talk to you about the 4 major types of accounts that you can open up at your bank or your credit union. Since each type has its own unique pros and cons, I figured I would sit down and discuss each of them with you side by side so you can figure out which account is best for you given your situation. So let's start with a savings account. Now this is probably the most straightforward account. The purpose of a savings account is exactly what it sounds for. It's for saving. A major benefit of a savings account is that it's easy to set up. Most banks allow you to set up a savings account pretty quickly with a low minimum for account startup. Another benefit to a savings account is interest. Money that you put in a savings account does gain interest, but with a national average of 0.06% interest, the gains are pretty small, but the fact that your money is still gaining interest is a major plus. Another major perk to a savings account is insurance. The FDIC, or the Federal Deposit Insurance Corporation, insures your money up to $250,000 if your bank is part of the FDIC, which most banks are. Credit unions have similar protections under a program called NCUA, which also insures your money up to $250,000. And this is a major perk, knowing that if your bank were to disappear tomorrow, your money would still be there. But there are some major cons to savings accounts. The first one being minimum balance requirements. Most savings accounts have these minimum balance requirements that you need to maintain or you're going to be charged a monthly maintenance fee. Another major con to savings accounts are federal withdrawal limits. Savings accounts are subject to federal withdrawal limits, meaning that you can only withdraw your money up to 6 times in a month. And if you exceed this monthly withdrawal, your bank might charge you a fee. So if you find yourself needing to make those constant withdrawals, a savings account might not be best for you, and you should maybe look into a checkings account. A checkings account is probably the most flexible of all accounts. And what I mean by this is you have easier access to your money than a savings account, with less rules about when you can actually access your money. The main pro of a checkings account is the ease of use. Most checkings accounts have online and mobile banking, which allow you to move your money around without actually having to go to a brick and mortar store. The next pro of a checking account is availability. Most checking accounts will give you a debit card and checks that'll allow you to pay for things with your account pretty easily. These debit cards can also be used to withdraw cash from ATMs. Just be sure to check that there aren't any fees associated with withdrawing from ATMs from different banks. The next pro to checking accounts is direct deposit. Most checkings accounts allow your employer to directly deposit your paycheck into your checkings account. And this is a great way to automate this piece of your finances. Another positive to checkings accounts is insurance. Much like a savings account, checkings accounts are usually covered under the FDIC. So up to $250,000 is covered if you're working with a bank that's insured by the FDIC. And while these are some really great reasons to open a checkings account, there are a lot of cons that are worth considering. And one of these is that there still may be a minimum balance that's required in order to avoid those monthly maintenance fees. Especially if you have easy access to withdrawing your money from your checkings account, you may fall under that threshold pretty easily. Another downside is that overdrafting is especially possible with the ease of withdrawals that come with checkings accounts. Overdrafting is what happens whenever you spend more money than is available within your account, which is definitely possible whenever you're using a debit card or you're writing a check and you accidentally go over the available money within your account. These can lead to some serious steep fees, so just keep in mind how much money you actually have to use before you withdraw from that. And the last con of a checkings account is that there is absolutely no interest. So the money that's sitting in your checkings account is not gaining that momentum and building your wealth. The next account we'll be discussing is a money market account. And this one is interesting because it blends a lot of the pros from the savings and checkings accounts. In essence, it's a high interest savings account that shares a lot of the features of a checking account. A main pro of a money market account is the interest that you gain, which is oftentimes a lot larger than a checking or a savings account. This interest is still a lot lower than, say, investing your money, but your money is still working for you. So even if this is just a modest improvement, free money is still free money. Another pro of a money market account is insurance. So like your savings and checkings accounts, the money market account will usually carry the same FDIC insurance regulations. And another pro of the money market account, like the checking account, is that it has a high ease of use. Money market accounts usually provide you with a debit card or checks that make it pretty easy for you to withdraw your money. This comes with a catch though, making it a great segue into our cons category. So even though you're given these checks and a debit card, you're only allowed to make 6 debit card or check transactions every month. Another con to money market accounts is that some of these accounts require you to maintain a balance to avoid those monthly maintenance fees. Some banks may offer you a higher interest rate if you maintain a higher balance, or a lower interest rate if you have a lower balance. So it's important to check the balance requirements before you try and get the most out of these accounts. The fourth major account type that we'll be discussing today is a CD, or a certificate of deposit. A CD is basically a high interest savings account with some added restrictions and regulations. The major pro of a CD account is the interest you earn. Typically, CDs will grant you a fixed interest rate on deposit, which allows you to see exactly how much money you'll make on that deposit within the year. The downside to this is that you're required to lock up your money for a fixed period of time, meaning that you won't have access to your money during this time. Typically, the longer that you don't have access to your money, the greater interest that you'll earn on this money. But this can vary between different institutions, so it's important to check what terms are best for you. This time that your money is locked away from you is the major downside to a CD account. So let's say you fall on hard times and you need access to your money. This isn't going to be as easy as a savings, checkings, or money market account with a CD. And for this reason, it's certainly worth considering if these high interest rates are worth having your money locked away for a long period of time. So those are 4 different accounts that you can open up with a bank and credit union. You definitely don't need all of these accounts, and usually people have maybe a combination of 3 of them within their portfolio. So definitely do your research, consider what's best for you, and decide how you're going to work these accounts into your monthly cash flow. Thank you all so much for watching. I hope you enjoyed today's video, and if you did, please consider liking and subscribing to the channel. I hope you all have a wonderful rest of your day. Bye!